Welcome back. Today we're breaking down one of the most real-time and forward-looking economic indicators that predicts actual economic turning points before official data confirms them, the Services PMI. Here's what you need to understand. Services PMI measures purchasing manager sentiment in the service sector, the largest component of developed economies. It's released mid-month, weeks before official economic data. It's based on actual business transactions, not surveys of what people expect, and it's incredibly predictive of recessions, recoveries, and shifts in central bank policy. While most traders are waiting for GDP, employment, and inflation data released weeks later, sophisticated traders are already positioned based on PMI signals. If you're not using Services PMI as a leading indicator, you're watching the economy in the rearview mirror while others are looking ahead. What Services PMI actually measures? The Purchasing Managers Index for Services tracks business conditions in the service sector through surveys of purchasing managers and senior business executives. They're asked about new orders, production, employment, inventories, and supplier deliveries. The index is composite, capturing real business activity happening right now. The PMI is constructed so that 50 represents no change. Above 50 means expansion, below 50 means contraction. The farther from 50, the more pronounced the trend. A PMI of 55 indicates moderate expansion. A PMI of 45 indicates moderate contraction. A PMI of 30 indicates severe contraction. The beauty of PMI is that it's real time. Purchasing managers are observing actual business activity as it happens. Orders flowing in or drying up, production ramping or declining, hiring accelerating or slowing. This is happening data, not backward-looking surveys. When PMI turns, actual economic conditions are already turning. Manufacturing PMI versus Services PMI. Most traders focus on Manufacturing PMI, which gets more media attention, but Services PMI is more important for developed economies because services represent 70% of GDP in the US and similar percentages in Europe and Japan. Manufacturing PMI often leads Services PMI. When manufacturing begins contracting, that often precedes services contraction by weeks or months. During recessions, manufacturing crashes first because investment demand collapses. Services hold up longer because consumer spending on services persists. For traders, watching both indices matters. Manufacturing weakness that doesn't spread to services often means contraction is limited to capital goods. Manufacturing weakness spreading to services signals broad-based recession. Conversely, services weakness that doesn't touch manufacturing often reflects consumer retrenchment without capital destruction. The leading indicator property, the critical advantage. Services PMI is released in the middle of the month for the prior month. Official economic data, GDP, employment, inflation, is released weeks or even months later. This timing advantage is enormous for traders. When Services PMI turns negative, you know contraction is already happening in the real economy. You don't have to wait for employment data to show job losses weeks later. You don't have to wait for GDP data to confirm recession months later. You can position immediately based on PMI signals. During the 2020 COVID collapse, Services PMI crashed to 26.7 in March, signaling severe contraction. Official unemployment data weeks later showed unemployment surging to 14.8%. Traders who positioned based on PMI in mid-March had weeks to position before consensus caught up through official data. During early 2023, Services PMI remained elevated above 50 even as traders were fearful of recession. This signal, when sustained, correctly predicted that recession wouldn't materialize. Traders who trusted PMI positioning for continued expansion were right. Those betting on recession based on other indicators were wrong. New orders, the demand signal. The new orders component of Services PMI is particularly important. It tells you whether demand for services is strengthening or weakening. Businesses receive fewer new orders when customers are cutting back. They receive more when customers are confident in spending. New orders often lead actual production by weeks. If new orders are collapsing while current production remains solid, that tells you production will collapse in coming weeks. If new orders are surging while production is stable, that tells you production will accelerate. For traders, the new orders component often tells the turning point story before the headline PMI does. When new orders turn sharply negative, be prepared for headline PMI to follow weeks later. When new orders surge, expect headline PMI strength ahead. Employment component, the labor market leading indicator. The employment component of Services PMI asks about hiring and staffing levels. It's a real-time measure of whether businesses are expanding headcount or contracting it. This often leads official employment data by weeks. When Services PMI employment is collapsing, you know official employment reports will likely show weakness coming. When Services PMI employment is surging, you know hiring is accelerating. During the late 2022-2023 period, Services PMI employment remained resilient even as recession fears mounted. This signal correctly predicted that employment wouldn't collapse and recession might not materialize. The employment component was telling you the labor market staying strong before official data confirmed it. Prices component, the inflation signal. Services PMI includes a prices component asking about pricing changes. It's not official inflation data, but it's real-time signal of whether service providers are raising prices and whether demand conditions support pricing power. When the prices component spikes, that often precedes CPI acceleration as service price increases flow through to official inflation data. When the prices component collapses, that often precedes CPI moderation. For traders timing inflation cycles, Services PMI prices are often an early warning. Surging prices component suggests pricing pressure will persist. Declining prices component suggests inflation is moderating in real time before CPI officially confirms it. Supplier delivery times, the supply chain signal. The supplier delivery times component indicates whether businesses are experiencing supply chain delays or not. Lengthening delivery suggests supply constraints. Shortening delivery suggests supply is abundant. This is a real-time measure of supply chain health. When deliveries are lengthening across services, that suggests supply constraints are building. When deliveries are normalizing, that suggests supply chain pressures are easing. For traders, this component helps you understand whether pricing power comes from demand or supply constraints. If prices are rising and deliveries are lengthening, pricing reflects supply constraint. If prices are rising and deliveries are normalizing, pricing reflects genuine demand strength. Regional and country divergence. There's US Services PMI from ISM, but also Eurozone Services PMI, UK Services PMI, China Services PMI, and PMI indices from most major economies. These don't always move together. During periods when one region is strengthening while another weakens, PMI divergence tells you where economic momentum is shifting. When US Services PMI strengthens while European PMI weakens, that signals economic strength concentration in America. For traders, watching PMI across multiple countries helps you identify which regions are entering expansion or contraction phases. This informs currency positioning and geographic equity allocation. Composite PMI, manufacturing plus services. Most countries also publish composite PMI combining manufacturing and services. Since services are larger, composite PMI is dominated by Services PMI. But comparing composite to services helps you understand manufacturing contribution. When composite PMI is significantly below Services PMI, that tells you manufacturing is dragging down the overall economy. When they're aligned, that tells you both sectors are moving together. For traders, composite PMI gives you the broadest economic picture. When composite turns negative, broad-based contraction is likely. When it turns positive, broad-based expansion is likely. Flash versus final estimates. PMI is released in two versions. Flash estimates mid-month based on partial survey responses, and final estimates later in the month based on complete responses. Flash estimates often get revised substantially when final data comes in. Sometimes flash is bullish, but final revises lower. Sometimes the opposite. For traders, watching both matters. If flash and final consistently align, you can trust the signal. If they diverge frequently, that suggests noise or survey issues. For event-driven traders, flash PMI release can be tradable even if final revisions come later, but be prepared for reversals when final data arrives. Surprises and consensus. Like all economic data, what matters most is whether PMI surprises consensus expectations. If PMI is expected to stay at 52 and comes in at 52, markets barely react. If it's expected at 52 and comes in at 48, that's a significant surprise moving markets. Consensus PMI forecasts get published before releases. Smart traders position based on whether they think actual PMI will beat or miss expectations, not just what they think the absolute level should be. This also means apparent weakness can be bullish if expectations were lower. A PMI of 48 beating consensus of 42 is actually constructive signal. The market rallies because contraction is less severe than feared. The opposite can happen with strong numbers missing expectations. Seasonal adjustments and volatility. PMI data comes seasonally adjusted, but services have different seasonal patterns than manufacturing. Year-end surveys sometimes show weakness from holidays even as underlying conditions are stable. January shows strength as economic activity resumes. Understanding seasonal patterns prevents you from misinterpreting seasonal noise as economic signal. For traders, looking at PMI trends over quarters rather than reacting to single months smooths out seasonality. A consistent trend downward across quarters is more significant than a single week month. The correlation with GDP. Services PMI historically correlates well with GDP growth. When services PMI is above 50, GDP usually grows. When it's below 50, GDP usually contracts. This relationship is loose but directionally reliable. For traders, PMI gives you real-time proxies for GDP direction weeks before official GDP data. This helps you position before GDP surprises arrive. What this means for your strategy: use Services PMI as a leading indicator for economic turning points. When PMI turns sharply, expect actual economic data to follow weeks or months later. Position ahead of consensus catching up through official data. Watch the new orders component closely. It's often the leading component indicating direction ahead. Surging orders suggest expansion coming, collapsing orders suggest contraction ahead. Monitor employment component for labor market signals. Strengthening employment component suggests hiring will remain solid. Weakening suggests hiring will slow. Track the prices component for inflation signals. Rising component suggests pricing pressure persisting. Declining suggests inflation moderating. Compare Services PMI across countries and regions. Divergence tells you where economic momentum is concentrated. Use this for geographic positioning. Watch for surprises relative to consensus. Position based on whether you expect PMI to beat or miss expectations, not just absolute levels. Look at trends across multiple months rather than reacting to single data points. Consistent directional trends are more significant than single-month swings. Most importantly, Services PMI is real-time economic data weeks ahead of official statistics. Traders who interpret PMI signals correctly position before consensus catches up through official data. That's where your edge lives for anticipating economic turning points and central bank policy shifts.